You know, when you pour a bowl of Cheerios or, I don't know, grab a Pillsbury crescent roll, you're not just having breakfast. You're actually interacting with a massive company, General Mills, that is right in the middle of a huge strategic shakeup. So today, let's dig into the new recipe they're cooking up to try and get back to growth. And that's a totally fair question, right? I mean, why would a company with so many brands that are basically household names need to rethink its entire strategy? Well, the answer, as it so often does, really starts with the numbers. Okay, so the big headline figure from their latest quarter is this: a 7% drop in reported net sales. Now look, any drop is a concern, but 7% for a company of this size, that definitely gets your attention. But that number, it doesn't really tell the whole story. See, if we strip out the effects of them buying and selling off parts of their business, what they call organic net sales, the decline is actually 3%. Now, it's a smaller number, for sure, but you could argue it's even more important because it points to a slowdown in their core, day-to-day business. And this is where that sales pressure really hits the bottom line. Adjusted earnings per share, which is a key way to measure profitability, fell by a whopping 20%. A drop like that, it just sends a clear signal that the problem is flowing directly to the company's profits, making it obvious that something had to change, and fast. So how did we get to that 7% drop? Well, this breakdown is pretty revealing. You can see more than half of it came from selling off businesses, like their yogurt brands. But look closer at that core business. They sold fewer items. That cost them 1 point. And they lost 2 more points on pricing. So the problem was hitting them from 2 different sides. They were selling less stuff and for less money. And that really gets to the heart of the issue here. Beyond all the financial engineering and spreadsheets, General Mills faced a simple, fundamental challenge: getting more people to buy more of their products. And hey, you don't have to take my word for it. The company's chairman and CEO, Jeff Harmening, he put it in no uncertain terms. This quote just lays out their #1 priority with absolute clarity. It is all about volume. So why this obsession with volume? Well, for a while, a lot of companies could grow just by raising prices. But that's a short-term fix. It's like a sugar rush. Real, sustainable growth, the kind that signals a genuinely healthy brand, that comes from selling more units, more boxes, more cans. That's the holy grail in the world of consumer goods. And it's exactly what General Mills is chasing now. Okay, so the challenge is selling more stuff. What's the plan? Well, the company has rallied around this single powerful idea, a new framework they believe is the key to winning back that volume growth. They're calling it the remarkability framework, and look, it's not just some catchy corporate buzzword. It's a strategic lens, a whole new way of making decisions. And the goal is simple: make every single aspect of their brands so good, so compelling, that you, the consumer, find them truly remarkable. And this is their new checklist. To be remarkable, a brand has to crush it across 5 different areas: the product itself, the packaging it comes in, the advertising you see, its availability both in-store and online, and finally, the value it offers. Every single brand is now being judged against this scorecard. Okay, that's the theory, but what does this remarkability thing actually look like in the grocery aisle? Let's check out some examples of how this is all playing out in the real world. Take a look at Cinnamon Toast Crunch. By focusing on all 5 of those elements, a great product, different pack sizes for value, and a really clever social media campaign, they drove a massive 500% increase in social engagement. But more importantly, all that buzz translated into actual growth, with the brand gaining market share. The product part of that framework is also delivering. The first quarter saw a whole slate of new items, things like Cheerios Protein and Progresso Pitmaster soups, that are all selling ahead of the company's own expectations. This is real proof that their innovation pipeline is starting to create things that people actually want to buy. Now here's a crucial milestone. This is a big one. For the first time in 3 years, General Mills successfully got its products into more U.S. households. That's a huge indicator that their strategy to win over new consumers, well, it's starting to work. They're also making some pretty big bets in new areas. This number, 5,000. That's the number of refrigerated coolers their Blue Buffalo pet food brand is expanding into with a brand new line of fresh pet food. It's a major investment in a fast-growing, premium category, and it shows they're putting some serious money behind this new strategy. So the early signs are promising for sure, but this is a massive ship to turn around. and the company is being very clear-eyed about the challenges that are still ahead. So what does the future hold? And will this bet on being remarkable really pay off? Well, the company's own forecast for the full year is basically flat. They're predicting somewhere between a 1% decline and a 1% gain in organic sales. What that tells us is they expect this to be a year of investment and transition, not a year of dramatic growth. They're laying the groundwork.
And they're also facing some serious headwinds. The new strategy requires heavy investment. At the same time, their profits are being squeezed by that yogurt sale and the return of normal employee incentives. And on top of all that, consumers are still watching every single penny.
And that really brings us to the final critical question. General Mills is betting that even in an economy where value is king, making their brands more innovative, more engaging, and ultimately more remarkable will be the key to winning. The question is, will it be enough?